Today, folks, for better or for worse, we live in a market where it's overpromise, underdeliver. I feel like that's the new Western world, the new America, because people don't just announce products anymore and then allow you to buy them. I mean, look at the new iPhone release where they were showing off AI tools that would come out on a software update. That overpromising leads to future expectations that drive stock valuations and make investors and shareholders happy. That's why the S&P is trading at such high multiples today, and I want to start looking at the earnings to see if we're heading into a correctional period or these future expectations are actually baking into some of these earnings and justifying the values we see today. Because a lot of people are sitting on the edge of their seat having a hard time with that itchy trigger finger saying now is the time to buy, because the S&P has just gone on a historic bull run yet again. I mean, in the last year and a half, 2 years, it's up 62% from those lows of the interest rate cycle. There's also a lot of expectation that with the interest rate cuts continually happening here, especially in Canada, that it's going to help boost the underlying fundamentals of these stocks, which is also getting priced in. So what we're going to talk about specifically here is the king of overpromise and underdeliver, for better or for worse. Where is Tesla going? Why is it up so much? As so many people were just hyped about these earnings. And we're going to wrap back around to this because I want to talk about the tech because it's one of my favorite stocks and where I'd be willing to buy it again. But let's just take a step back and I want you to take a look at the earnings we have, because if we broad view these just briefly, what you're going to notice is that a lot of companies are actually posting reasonable earnings. Like they're posting revenue, everything seems to be trickling to the upside, but not enough to justify the absurd valuation that almost all these companies are trading at today, which is one of the reasons a lot of their stock prices are coming down on the back of relatively reasonably good earnings, which is why we're starting to see the price to earnings multiple actually start to trickle to the downside. And we need to take a real breath here, because some of these like Warren Buffett favorites, like even CocaCola, somehow commanding almost a 28 price multiple, even though when you read into it, they surpass their earnings and revenue estimates, which is the dumbest job ever. Imagine an analyst, a guy that doesn't even work at your company, says this is what it's going to do this quarter, and if you beat it, the stock goes up, and if you miss it, the stock goes down, even though you could be posting really great numbers. It's such a stupid industry and job. But yeah, we're talking about 2% revenue growth here. Net operating revenues are absolutely... Are these exciting? Yeah, if you're collecting dividend income, sure. But for the most part, against the backdrop of a 28 price multiple for a company that has like virtually no revenue growth right now, is this really what we want to be paying for a company like Coca-Cola? I mean, look at IBM. These are like grandpa stocks. You go back, look at General Electric. These companies that have really turned their fundamental businesses around, but do they command like a 20 to 30 price multiple? I mean, you read into this, they slip on disappointing consulting and infrastructure revenue. But when I actually take a look at their revenue and their earnings, I mean, they're not bad. They're growing. Again, we're talking single digit growth, nothing crazy here by any metric. Gross profit, more or less in line to what they were experiencing last year. So why is the company with virtually very nominal single digit revenue growth commanding the highest price to earnings multiple that it has pretty much in its history of the company? Look at UPS. I hate UPS. They don't deliver stuff to my door like Amazon does. They typically drop it off the pickup across the road. Super annoying. They jumped on, earnings here. They're seeing their price to earnings at a 22 right now, which again is historically high, and they beat analyst expectations, which caused the stock to, jump a little bit. But these are companies that have like nominal, like single digit margin, are companies that I usually don't want to mess around with too much. And this company, I think I have exposure to because it's in SCHD and it has gone on an abysmal downtrend. But even on its downtrend, it's justified because again, there's been really hardly any revenue growth here. And when you take a look at that price to earnings against income, like the stock is holding up too much still for the earnings valuation the company has. So these are things that typically, again, with UPS, we don't want to be seeing, right? But for these other companies, as long as they keep posting numbers and their stock prices go down, we're in a much better, healthier market environment. But look at Canadian National Railway. It's down on earnings. Newmont Corporation down on earnings. American Airlines is down. Southwest Airlines is down. The only ones flying up are these highly speculative companies that are really not justifying these absurd valuations. Look at MicroStrategy here, just popping off this week, up almost 20% as Peter Schiff, of course, predicts a bloodbath, calling MicroStrategy the most overvalued stock basically in the world index, which I find absolutely hilarious because he might not be wrong. And speaking of overvaluations, Tesla is the most intriguing because of the infrastructure valued, right? You're talking about a company that has multiple components, and trying to value those components are going to be valued like small cap growth oriented companies. We're going to base it off some future expectations. So you're going to pay a higher multiple for that, right? Because they're not really generating revenue yet. So if we take a look, everyone was excited not because of the revenue, because again, 8% revenue growth, who cares? I mean, for a company trading at a an Nvidia like multiple, but like can't even command like a tenth of the growth. I mean, we have to understand it's not that driving the stock price here today. It's free cash flow popping off, a return to margin. The company's finally seeing, operating margins return. They're up 323 basis points to 10.8%. Ooh, right? 10.8% for a tech company. And I'm not trying to shit on Tesla too much because I believe in their future. But the thing that scares me the most is I still have a hard time stomaching the valuations on it because Tesla has very virtual no revenue growth again. And we're still sitting in a market environment where their price to earnings multiple, the best price to earnings was 2022. When you caught it on that $100 dip there, you could have picked it up for, a 30 times multiple. This was cheap for Tesla's future value, in my opinion, because again, the company has a lot going for it, but what it has going for it still doesn't exist today. And that's why I still think we're going to see volatility in the stock. I have a hard time buying it here. If anyone's buying it here, you got a lot more cojones than I do. I'd rather get my exposure through the index and let self-driving and some of these future expectations work themselves out because there's no concrete conclusion. I mean, look at this video here that from self-driving that now Elon's promising is going to be ready next year. Again, we hear it again. It wasn't even an odd 2 or 3 quarters ago. It'll be ready by the end of this year. And here we are sitting in the final quarter of the year, and this is what self-driving is doing.
We're clear on the left side, but we can't proceed anyway because of the people on the right. Okay, it's proceeding forward. You shouldn't need to do that.
So again, I'm watching these videos religiously. I would have no problem buying Tesla if it was generating revenue off self-driving today, but it still can't prove that it can operate at scale because these people go out in these busy cities, they try and do stuff, and you cannot have an intervention every single drive like this. Like this could have caused a serious accident if this guy didn't, intervene. And this is just one example of many that I continue to see. And it's not negative against the company because they're so damn close to getting full self-driving, but I can't be paying a valuation as though as it exists today. Same with the robotics and stuff like that. So it's always going to be priced to some extent in the stock. But what I want to see is more fear. Like maybe, Trump doesn't win the election and Tesla stock drops or something like that. Or maybe something like that comes into play where it doesn't materially really affect the company. I mean, if Trump wins, I think that could be bullish for Tesla overall. It's going to give Elon probably some direct control over, the actual government regulations around electric vehicles and what they think of Tesla. Because we know, the other side doesn't really like Tesla as much in comparable, the way they talk about it. So who knows, right? But what I want to see is some of those short-term interferences really affect an overvalued stock price so I can pick it up when people are more feared and there's more blood on the street. But we're just trading way too much right now for me to do anything other than stack cash and continue to cost average because you don't want to stop buying up here because you just don't know. But again, you can't help but recognize that what we're seeing today is a very expensive market. But again, I'm always going to be making moves. I'm not just going to be like forgetting buying stocks altogether, but I will pass the question off to you. I'd love to know what you're doing in this very fascinating market environment.